Despite the surge in stocks today, it is time to defend your portfolio. That is the call from Jason Pride. He's Director of Investment Strategy at Glenmede, and his firm manages $19.8 billion in assets. Welcome back to the Close on Street Smart. Jason, good to see you
Thanks
once again.
Me, Lisa.
What do you make of this rally here? A little too euphoric?
Look, this makes sense given what came out. Europe brought out the big guns here in trying to get a resolution in place. $1 trillion sort of expansion of the, or €1 trillion expansion of the EFSF, a recapitalization of banks back to 9% core tier 1 ratios, using $100 billion plus to take on the peripheral banks and doing more perhaps within Germany and France by themselves. This is the sort of solution they need to at least put behind the systemic risk of the banking system unraveling in Europe. Doesn't mean that everything's solved. We still have competitiveness problems in Europe. We still have debt balances that are too high and have to be fixed. But this is a significant step towards fiscal unity, and fiscal unity can heal a lot of wounds as it relates to the European debt situation and many of the financial problems that surround it.
So, Jason, you might use the rally we've seen of October to actually set yourself up for a more defensive position. How would you actually do that? Buy treasuries at this point? They've certainly gotten cheaper.
So here's the thing. We've been advocating a defensive posture, but not an overly defensive posture. Our thought process is we still have a debt problem in the U.S. We still have a long-term debt deleveraging in Europe. There are a lot of things still standing out there. But that doesn't mean just hide in cash and treasuries. That means actually come into the middle, take away some of your more aggressive equities, but also don't buy cash and treasuries. Buy things in equities that are more defensive, in fixed income that perhaps is a little bit more risky, and actually put majority of your portfolio in the middle, positioning for a slower growth environment and defending your portfolio along the way. So part of that means buying high-quality stocks, being defensive within equities while you're more aggressive in fixed income.
There have been an interesting, it's a good point of conversation right now, Hewlett-Packard, because it's not the only company that has had some interesting sort of reversals in decisions they've made, surprising decisions that they've decided to go back on, right? We heard from Netflix not that long ago. What do you make of a climate like this, and how do you avoid companies that are sort of changing gears this quickly?
I think you could look at that as occasionally it'll provide an opportunity where valuations will pull back in. You'll get an opportunity to buy a great longer-term company. Other times you simply recognize that sometimes a lot of these disruptions are occurring for a reason, and that there are underlying problems at the company that they are trying to resolve. If that is not reflected in the prices, then we tend to stray away from those situations. Majority of what we're focusing on in the equity marketplace right now are those more conservative, defensively oriented companies, more stable companies that hopefully would have less of these problems along the way.
You're also, I noticed that your specific picks, Philip Morris, Yum, Colgate-Palmolive, these are large global companies. Is it exposure to Europe that you actually think maybe is largely discounted at this point that makes these good picks, or is it sort of exposure to countries outside of the U.S. and Europe?
It's outside of the U.S. and Europe. We think the majority of the growth for the coming years is probably going to be coming from the emerging market consumer. Reality is the emerging market consumer has now surpassed the U.S. consumer in contribution to total worldwide consumption. And they're growing relatively quickly. When you look at the numbers, many of those countries are putting in place 10 to 20% wage increases for the vast majority of their population, whether it's government mandated or whether it's simply those companies that are in those locations bringing the wages of that population up to more normal standards on par with the rest of the world, or at least getting closer to there. As they make that extra amount of money, yes, they save some. In fact, their savings rates are a lot higher than ours, in some cases as high as 50%. They do spend some of it, and they tend to move more into consumer discretionary orientation. This means they buy cigarettes. This means they go out and eat at restaurants. This means they buy toothpaste. So all three of these situations, we're attaching to that growth of the emerging market consumer as one of the avenues of growth, while also trying to keep stability as a key theme within the portfolio.
Covering a lot of asset classes here, so I want to talk about bonds. You actually like some international sovereign debt. Which countries in particular do you think offer safety at the same time yield?
So, this is an interesting environment because in a lot of nations, you have yields that have been brought down to rock bottom levels. U.S., Germany, Japan. It is hard to collect a reasonable interest rate in the majority of these economies. And these tend to be the safer economies according to traditional thinking. But when you look around, what you can actually find is two categories of bonds sitting out there that are a little bit more attractive.
Jason, I'm sorry, we're going into break.
Jason, I know you have a very specific checklist of what you want to see come out of Europe. How much of the headlines today actually made your checklist?
I would say actually a good amount of it. When you really dig through what we needed to see, we wanted to see the EFSF upsized in order to provide some credibility they would have enough funds. We wanted to see a very clear statement as to banking recapitalization. And we also wanted to see a commitment to save the financial system, to basically make sure that you didn't have cash fleeing from banks. And in order to do that, basically, you needed to make sure that the interbank lending market operated properly and the deposits were effectively backed by the governments. And it seems like if you go through that checklist, those three major things were put in place. We still think that there's work to be done. Competitiveness in Europe still is not resolved. Majority of these countries the wages are not in par or on par with one another. So there's a lot of painful adjustments to go through. But at least we've gotten to a point where you can look at the deals and basically say that if the EU leaders are really behind this plan, they're committed to make sure that the system itself, the financial system, does not unravel. And that checklist seems to be complete.
All right, Jason Pride of Glenmede Financial, thanks for joining us on one of the two very big stories of the day.